Welcome to another episode of Wealthy Life with Ralph, your host. This is not personal financial advice, obviously, just general information, and a lot of it is my personal point of view. Hopefully, you get some benefit out of these videos, and if you've got any topics you'd like covered, just drop a comment or there's an online questionnaire you can fill in. So, today I'm just going to go through a very brief introduction on how to build a wealthy life. Um, it's very top level, just the major points, and I'll go into a lot more detail on some of these in future videos. So basically, just to start with, how to build a wealthy life, you need to formulate a plan. And as with all plans, it needs to be realistic, measurable, and achievable. And the main components of the plan you need are firstly, knowing where you are. And this would cover things like knowing your net worth, having a budget, knowing your preferences and being self-aware about risk tolerance and knowing your risk capacity. Second item would be knowing where you want to go. And this would be things such as deciding what your goals are in the short and medium term and in the long term, such as retirement planning. And third would be knowing how to get there. And this would cover things such as the savings rate you're willing to contribute, the duration, how long you're going to be doing this for, the expected risk and return for your chosen asset allocation, and then some minor tweaks such as rebalancing, dollar cost averaging, and fine adjustments to asset allocation. So we'll go through some of these in a bit more detail. And then the final component is you should mitigate risks, both during the journey, such as insurances and eventually self-insurance, and then when you're retired and no longer have much incoming income to invest or no surplus income. And this would cover things such as annuities, asset allocation adjustments, and trying to work out what the safe withdrawal rate during retirement based on your level of retirement savings would be. So going through some of these points of how to do a plan in a bit more detail, knowing where you are. First step would be your net worth calculation. When you're starting out, this may be fairly small or even negative, but a net worth is simply your total assets minus your total liabilities. So your assets would include things such as any money in a savings account, any share investments or other investments in funds, assets like cars, jewelry, property, anything you might have. Um, but mostly when you're starting out, your asset is time, because you have a long period of working life ahead of you, and your biggest prospective wealth builder will be your earnings capacity over future years. So at this stage, you might be looking mainly at developing your skills and building up to a higher long-term income earning capacity, such as completing trade or tertiary education, um, possibly learning skills to run your own business and those sort of things. Um, so, in liabilities, that's obviously things like any student debt you incur while getting those educational qualifications, credit card debt, which is generally a bad thing. I'll go through how to use credit cards sensibly in a future video. Um, Other personal loans and debts, a mortgage balance if you've got a mortgage, and any other money owed to parents, friends, whatever. Um, Hire purchase on cars, those sort of things. So if you take all your debts away from all your liabilities, that's your net worth. Um, when you get a lot older, you might not include your home as part of your assets. So your home and the outstanding mortgage balance, you might put that to one side because you need somewhere to live. So you might only do net worth based on investable assets and liabilities against those assets. But in general terms, it's all your assets minus all your liabilities gives you a net worth. Um, Really, it's just a scorecard to see how you're going. There's no right or wrong answer with a net worth. It is what it is. Obviously, you'd like to have a higher net worth than a lower net worth, but you usually trade that off against consumption. So if you save more, you end up with a higher net worth, all the other things being equal, such as returns and risk. Um, but you're foregoing some current consumption for future increase in net worth. So that's a choice you make along the way. The second item of knowing where you are is your budget. A budget's not a prescriptive um, set of rules that you have to follow. It's simply a technique of looking at your current income and outgoings. So you look at your income from salary, any other income, side gigs, whatever, and you look at your total expenses and you divide those up into things you need, such as housing, food, utilities, possibly insurances, and regular commitments to pay off card debt or whatever, and things you want, such as discretionary spending items, entertainment, eating out, going on holidays, those sort of things you could do without, but you choose not to. So if you take away all your expenditures from all your income, that should end up being a surplus available to invest. And then if you write down a savings item as part of your budget, you'll end up with a net zero budget where your expenditures match your um, income. The idea is to analyze your budget. Well, first you write it down based on historical um, data. So you'd look at your last month if you have only started out, or you might look at the last year's worth of expenses. I tended to put all my expenses on a credit card, which I paid off in full each month, and that makes it very easy to go through and download electronically all the items and put them into a spreadsheet and categorize them as needs and wants and subcategorizing them into, utilities, household expenses, clothing, eating out, children's expenses, gifts, donations, holidays, clothing, whatever. Um, so you get your total budget for the last month or the last year, and if you do a monthly budget for the last month, you'd try to extrapolate that for a year. Just be cautious you don't overlook things that are ad hoc, such as quarterly utility bills or once a year payments for subscriptions or something. So you get your monthly average as much as possible, and you compare your income to expenses. And if there's a surplus, you can earmark that to savings. Or if you've already got a savings plan in effect, you write down what percentage or what dollar amount you're saving each month, and that will give you an overall budget. The next step would be to look at your budget and decide whether it's what you actually want. So you might decide that I'm spending too much money on takeaway food, or I might be spending too much on entertainment, going out to events or something, and not enough on savings. Or you might decide your savings rate is right, and you've got a little bit of surplus in the budget, and you'd like to sort of put that into an account for short-term savings for a holiday or something like that. So the point of a budget is to have everything written down and summarized so you can actually evaluate whether it's what you would like or whether you'd like to modify the budget. Um, and then going forward, you use the budget to track how your actual expenses each month marry up with your expectations. So if you've budgeted $100 a month for takeaway food and you find out last month I spent $250, you might say, oh, I need to cut back a bit on the eating out lunch at work each day and brown bag a sandwich, a couple of times a week or something like that. Or you might be underspending. You might say, oh, I was going to donate 10% of my income, for example. Not that I do. Um, and then, after a couple of months, you might realize I'm not actually doing that level of donations. You might want to set up a regular donation or pick out a charity and um, make a gift or something like that. So you look at your actual expenses versus the budget and see if you're on track of where you thought you'd be after you've done the initial evaluation of the budget to see if it's what you'd actually want to do. Um, then, having got your net worth and your budget, you're pretty well knowing where you are. The only other things you need to know are your preferences. So you should consider whether or not you prefer shares to real estate. Some people really don't like shares. They think it's sort of like a casino, gambling. Um, that's really just a factor of being aware of the volatility versus real estate. It's not marked every day to market, so you don't know the daily volatility in prices. Tends to be smoothed out and look less volatile, even though there is quite a bit of volatility. Probably if you look at the suburbs um, where you live and you look at house sales for the last couple of months and you looked at the range of prices, even though part of that is due to the actual property features, size, condition, all those things. Part of it will be due to the volatility of each sale being an individual transaction. So you never really know what your house is going to sell for until you put it on the market and you come across a willing bidder. And the best bid is probably the one you would take, all other things being equal. But you don't know what that best bid is. You can work out an average price or an expected price, but with property, you don't really know what the value that you'll get for property is until you try selling it. So it's a bit different to shares where you actually know day to day what the current market price is because they're a fungible asset. So each share is the same as every other share, whereas each property is a unique instance. Um, but you know your preferences, whether you prefer investing in real estate or whether you prefer investing in shares or you prefer investing in funds or art or Bitcoin or bullion or whatever. So just be aware of what your preferences are in case you want to rule something in or out. And look at the performance. Typical historical performance is not a reliable indicator of future performance, but it's the best guess we've got often. So you look at the historic returns that have been achieved. So you don't just think about, oh, the last 2 years have been great for real estate or the last year's been fantastic for the S&P 500. You look at, well, what that asset class does over decades or even the last 60, 50 years. Looking at the last 200 years of stock market performance may not be a great guide for future performance because the world has changed considerably since the 1850s. Yeah, assuming past performance from a long time ago when the world was different is a reliable indicator of future performance is probably not a great idea either. But the last 50 years or so is probably a reasonable approximation of how things might turn out in the next 50 years. So if you look at real estate, art, gold, silver, property, I'd suggest you look at like minimum 10 years and more likely 20, 30, 50-year historic performance to get a rough idea of what the sort of relative performance of those asset classes are. And look at the charts of the volatility to see how they've gone up and down over time. And then the final thing of knowing where you are is to look at your risk tolerance and risk capacity. So, how comfortable are you with prices going up and down on the stock market? If you can ignore it and just think long term, that's fine. If you've actually got money at risk and you get upset because it's dropped 20% in value in the last 2 weeks, um, that may not be the best asset class for you. And you've got to be self aware enough to know, will I really be able to ride out downturns, or will I just think I can ride out downturns and actually panic and shift assets at the least appropriate time? Because a lot of investors uh, don't achieve the long-term historic performance because they try to time the market, and psychology tends to mean you do the exact opposite of what you should, which is buying when it's low and selling when it's high. People tend to panic when it's low and sell out, and then get enthusiastic and buying in when it's on an uptrend or at all-time highs. So, um, yeah, being able to absorb the risk or the volatility of a particular asset class is part of the decision-making process. And then risk capacity is how much you can actually absorb those losses. It's all fine to say, I'll ride out a downturn. But if you've got no income because you've lost your job and you need to pay your bills, you might have to sell some shares off, even though the market's tanked and that's why you lost your job. So if you got the risk capacity to ride out downturns, that's fine. But if you don't just assume you can ride out downturns. So that's where often having a emergency fund or um, liquid assets that are available in an emergency is good if you're planning on long-term investing and not selling out because you have to. So having got through all the steps of knowing where you are, you can then think about where you want to go. So in terms of short-term goals, this would be whether you've got any um, immediate plans for expenditure, such as going on a holiday or buying a new car, or ideally a good condition used car without a loan. Medium-term goals, such as putting the children through um, school, or university, buying a house, upgrading the house, buying a weekender holiday home, those sort of medium-term goals. And then long-term goals generally mean things such as how much you'll need to save up to be able to fund your own retirement, and whether or not you may or may not get the age pension or part pension. So how much you think you need to fund your retirement when you stop working and earning an income. So the third step of the plan would be now you know where you are and where you want to get to, deciding how you're going to get there. So this would be the savings rate required to meet those goals. So if you're got a net worth of zero and you've got an income of $100,000 and you're willing to save 10% of that, and you want to retire with $50 million when you're 60, that's just off the top of my head, probably not feasible. Saving 10,000 a year at any realistic historic rate of return, you would not get to that end goal within that time frame. So you can look at whether you need to lower your expectations, set a more achievable end goal, stretch out the time frame. So retire at 65 might be more realistic than retiring at 40. Um, Upping your savings rate. So you might say, oh, yes, I want a luxurious retirement and retire at 55. So I'd need to save 25% of my income, and I need to increase my income within the next 5 or 10 years to a higher level. So I need to get a master's degree or something. So you can look at the variables and tweak them to see how you could get to that desired end state by adjusting the parameters. Whether you'll be able to get those parameters to behave the way you want is another question. So that's how you would monitor your plan over time, see whether you're on track or not. But at least you'd know initially what the requirements would be to achieve that end state. So, for example, you might say, I want to retire with $2 million. I earn 100,000 a year. I want to save 25% of that, which is 25,000 a year, including super guarantee or whatever. And I'm going to invest in a high growth portfolio of equity based index funds. Um, would that be realistic? Well, that's sort of what my plan was, and yes, it was. But yeah, you've got to look at your requirements and whether the parameters make sense or are reasonable, and if you need to tweak them. Like you might find you need to save 20 or 25% of your income rather than the 10% via the SGL, or 12% now. So you can make a decision then whether you're willing to um, do that, or whether you'd rather spend more on current consumption and lower your expectations for the end goal. Um, And then, depending on what your preferences and risk tolerance were, you'll have a chosen asset allocation, and you'll have historic prediction of what you may be able to expect in terms of risk and return, and you would feed that into that planning process to see whether you're going to achieve the end goal you want. And then you might look at tweaks such as rebalancing. So if you've got an asset allocation that's 50% shares and 50% bonds, over time in any particular 5 year period, bonds might do better than shares, or shares might do better than bonds. And rebalancing just lets you automatically sell low and buy, so sell high and low, buy low. So you rebalance from the outperforming asset into the underperforming asset to keep your same asset allocation over time. And in terms of your target asset allocation, rebalancing will do better than not rebalancing in general, although it may actually not produce the best end result. For example, if your allocation was 50-50 and over the 30 or 40-year investment time frame, equities perform better than bonds, which wouldn't be a great surprise. By not rebalancing, you may actually end up with a higher end value net worth than if you had rebalanced. However, your risk tolerance may not be in line with that. So after 30 years, you may find you've drifted to a 70% equity, 30% bond portfolio. And given the higher volatility of the shares, when there's a market slump, you might panic and then rebalance to 70% bonds and 30% shares just when the market's crashed. And that would not be a good thing. So rebalancing can help you stay on track for your acceptable level of risk tolerance. Dollar cost averaging, that's just you. Most people don't have a lump sum of $1 million to invest when they're 20. So if you're going to invest $1 million during your working life, it would be 10% of your after-tax income every month, and you'd average that in by buying a little bit every month. So it wouldn't be a lump sum. Technically, investing the lump sum up front usually is better than dollar cost averaging in. But that's not usually a choice. And in terms of dollar cost averaging versus saving up for, say, a year or two in cash and then investing in a lump sum, it's really not of a benefit to save up and invest a lump sum, because the period when you're accumulating the cash, you'll probably be producing less performance than if you're actually allocated into your chosen asset allocation each month. It also helps dollar cost averaging in a continuous uptrend. It doesn't really provide any difference. But if the market drops, then rises again, by dollar cost averaging, you will have bought at a lower price proportionately more, because you're investing the same dollars, but you're buying them at a cheaper unit price. And when the price goes up, you're investing less units for each dollar you've invested. So you're actually buying low and selling, buying more when it's lower by dollar cost averaging. So it actually can help perform better just as a thing in itself. Final step, you would obviously then track how your reality is going compared to your projections. So if you've projected you're going to get onto your early retirement at 55 with a particular savings rate and asset allocation, if you find out after 10 years you're behind where you thought you'd be, you might either need to readjust your end goal, work a bit longer, or retire with a bit less, or you might need to increase your savings rate to get yourself back on track. So you really just evaluate how your actuals go against the plan, same as you review your budget actuals versus expectation each month. Probably only need to do that once a year just to do a appraisal of how your plan is going. And over time, you might have changed some of your parameters. You may have learned a bit more about shares or equities, or there might be a new wonderful investment opportunity like Bitcoin or something that's cropped up, touch of tulips, South East Coast bubble, whatever. So you may have new decisions made about different assets you want to try investing in. We may have ruled something out because it hasn't done as well as you thought it might. During the journey, you want to mitigate risks. So when you're starting out, you've got a lot of earnings potential for the next 30, 40 years and not much capital, and you might have large liabilities such as a home mortgage. And if you've got a young family and a wife that wouldn't be able to afford the mortgage if you died, life insurance is probably a good idea. And you may also want to look in other types of insurances, disability insurance, trauma insurance. That's not probably the greatest insurance ever. Um, Total and permanent disability insurance. And as you get older and you have higher net worth relative to your liabilities, you may find that you need less insurance over time. Your kids might finish university, so you don't need to have money put aside to fund that if you are no longer here. So you may be able to reduce insurances and self-insure from some point onwards. And when you're retired, risk mitigation is handled slightly differently. Initially, you might want to lower your asset allocation risk profile. So you might move from 100% shares into a more balanced portfolio if you've got enough money to fund your retirement income needs with a more uh, lower risk asset allocation. Like they say, there's no point continuing to play the game if you've already won. Alternatively, if one of your goals is to leave an estate, as in my case, then you may be comfortable um, keeping the same asset allocation because your goal is not just to die with zero, but to die with a higher net worth than you entered retirement with. But you look at that, whether you need to adjust your asset allocation when you retire. Um, if you've got barely enough to fund your retirement, you've just hit your goal just to fund the retirement with no surplus, you may need to look at the safe withdrawal rate, whether it's the Bill Bengen 4% rule or a slightly higher rate for a portfolio that's not 50-50 bonds and shares, um, or whether you want to mitigate some of the sequence of returns and longevity risk using a annuity product. So you'd look at those sort of things of mitigating risk when you're in retirement. I'll go through some of those in a future video about safe withdrawal rates, dynamic withdrawal strategies, annuities, those sort of retirement questions. I'll do it in a later video. So that's it for today. Give me a thumbs up if you like the video, or subscribe if you want to see more of these in future so you get notified. And I'll see you next time. Hopefully more than one person views this video.